The monetary climate has changed and inflation has taken off, and central banks have painted themselves into a corner. That's according to my guest on GoldCore TV this week, Ronni Stoeferle of Incrementum Asset Managers, who believes that all of this could send gold to $5,000 and as high as $12,000 over the next few years. All this and more in today's episode of GoldCore TV. And if you want to see more interviews with thought leaders and industry experts in financial markets, subscribe to GoldCore TV and hit the notification bell now. Ronni, welcome back to GoldCore TV.
Hi, Dave. Good to see you. Thanks for having me again.
Now, you have just released your latest version of the In Gold We Trust report. This is an annual report that is followed widely by many in the gold industry. You highlight a few points, key points in that. What I want to refer back to is actually, first of all, is the special inflation report that you released about just over 6 months ago. And the boy who cried wolf, basically. We're starting to see the inflation that you warned about coming through. Where next?
Yeah, I mean, it is happening as expected. Sometimes even I make a good call. No, but I think when it comes to the whole topic of inflation, of course, it is something that is quite complex and for our funds, we are really we're researching this topic really very, very detailed, and we developed our incrementum inflation signal. For example, we studied inflation, we studied the different theories around inflation, and it's important to say that inflation is always a process. It's not one point in time; it is a process that is happening, and I think, and this is one of the main takeaways of the In Gold We Trust report, it seems that the deflationary or disinflationary drivers, they're becoming less and less strong, while inflationary drivers are really taking over now.
And if we looked at those two things, so we said the disinflationary pressures that are not as strong anymore. What would we include in that?
Well, obviously it's the 3Ds, which is debt, demographics, and deflation from the technology side. I think they are still strong, but I think that inflationary factors are now becoming even stronger. Now, what are those drivers? First of all, I think it's this move from monetary dominance to fiscal dominance. I think since the beginning of the COVID crisis, politicians really took over from the central bankers, and we're seeing that nobody cares about fiscal conservatism anymore. Nobody cares about deficits anymore. I think this is one big driver. Then we're seeing some sort of a politicization of credit with basically government guarantees for loans. Russell Napier did a tremendous job highlighting this development, and I think, and I agree to Russell, that big government is back, and they, of course, many people would say now that the COVID crisis is over, we will go back to normal. No, I think that politicians really enjoy fine-tuning and micromanaging the economy. So I think that central bank policy will become less and less important, while fiscal policy will become more important. And then we're seeing many other drivers like demographics becoming more and more inflationary. We've got a special chapter about this long-term factor. We're seeing the dollar significantly lower over the next couple of years. We're seeing that the Federal Reserve moved to average inflation targeting, which is probably one of the biggest shifts in central bank policy ever. And of course, we're seeing that markets are already telling us, well, inflation is a concern. Let's have a look at market-based inflation expectations near a decade high. Let's have a look at 10-year break-even tips. University of Michigan consumer survey. They're all telling us, well, inflation now is finally here. And my main concern is, or my criticism is, from my point of view, it is not temporary or transitory, like central bankers keep telling us. It is something structural.
You're not buying into this transitory inflation narrative that we're hearing out of the Fed at all?
Not at all. Not at all. I think that the Fed is playing with fire now. They're openly telling us that they will let inflation rates overshoot, and I think the main thing that I criticize is this hubris that they think with their sophisticated models they can really fine-tune the economy and inflation and equity markets and bond markets nowadays. It won't work, yeah. And I think really the litmus test will be the whole taper discussion. It is now slowly starting. We all remember the taper tantrum 2013. We all remember what happened to markets. We all remember what happened to the US dollar. So from my point of view, this time around they will have to be much more cautious, and from my point of view, the markets will give them a really hard time, as the markets are so addicted to ever increasing amounts of liquidity. So basically that the Federal Reserve and all central banks are trapped, and now as they don't have any tools anymore, it is the time of governments, of fiscal policy taking over, and we could therefore basically say that we have arrived in some sort of a MMT environment, yeah. And I think before the COVID crisis, MMT was something that was discussed. It was a bit of a mostly from left-wing economists in their ivory towers. Now it is really mainstream, and it is accepted by basically everybody that this is a good thing. That universal basic income, helicopter money, all those things, they are now real, and I think that we just won't go back to the old regime very quickly.
So money printing then continues.
Obviously, there's no real way out, and we saw that. One of the main drivers for gold entering this correction after making new all-time highs last summer. One of the main reasons, obviously, was that rates were rising. So the 10 years went from 0.5% up to 1.75 in March.
You have a great chart that you use in the report to actually show this, the inverse of the rates overlapped on the gold price, and the correlation is extremely strong.
It is, and it's no coincidence that rates made a low on August 6th or 7th last year, and that the price of gold made an all-time high in US dollar terms exactly on the same day. But we all know that at 1.75%, the markets were getting really nervous about this big rise in yields, and like a little baby calling for mommy and daddy. Everybody was said, well, at some point we will need yield curve control, and this is clearly telling me that we simply cannot deal with and we cannot afford higher rates anymore. So obviously, one of the main takeaways of the Gold We Trust reports is that that real rates, that negative real rates, are here to stay, and we joke around in the report saying that before we see significantly higher real rates, probably a Dutch skier will win the downhill race in Kitzbühel. So it is not very, very likely to see something like that. And I think, as you know, now we're seeing the highest debt levels in peacetime, and they continue to rise. I think a real reversal in rates, and especially in real rates, is basically impossible.
So real rates can't go higher, basically, which is nominal rates adjusted for inflation. They can't go higher. Money printing continues. Inflation continues to increase. Bond markets potentially capped by yield curve control. What does this then all mean for gold?
Well, I think that's a perfect storm for gold. Negative real rates are probably the most important driver for gold. I think now with when it comes to inflation, I think most market participants still believe that the Federal Reserve and central banks have got everything under control, so that it is really only transitory. But at some point they will wake up and see, okay, well, it's probably not the best idea to have negative yielding bonds in my portfolio when inflation expectations become unanchored. So I think really inflation is the big story for gold going forward. Now there's, I think, 13 trillion invested in negative yielding bonds. We are seeing that many other investments, also equities. Yeah, I think that's one of the main takeaways of our last study on inflation. Equities aren't the best inflation hedge. It really depends on the sector. So once inflation really becomes a major topic in financial markets, and it has started so over the last couple of weeks, then I think people will realize that A, commodities, and B, gold are the best inflation hedges, and that they've got the highest inflation beta. And I mean, let's face it, we're seeing, have a look at commodity prices. Of course, they look a bit extended, so I'm seeing quite overbought situations, but it seems that we're really in a new bull market. When it comes to gold, we shouldn't forget gold was up 25% last year in dollar terms. It was up 15% in euro terms. People shouldn't become too greedy, and I think, after this correction, which ended in this double bottom in March at 1680, I think now we're really at healthy levels, and I can tell you now that we're around 1900. Nobody really cares about gold. So sentiment-wise, it's a completely different environment compared to last summer when everybody was talking about gold. So that's a very good sign from my point of view. I like silver at these levels. It looks really explosive from a technical point of view. I think the mining space looks terrific. Last year we saw all-time highs in free cash flow production in the gold and silver space. This year will even be better. So I think if you as an investor are really concerned that inflation will go higher, then obviously, gold, silver, commodities, and mining equities should be your first choice. And I still see, this movement has started, and in one chapter we compare it to this dancing Sasquatch guy. I don't know if you remember that video when there's one guy at a music festival, and he starts dancing like crazy, probably on drugs. And then it takes some time, and then a real mass movement starts. Yeah, and it's there are fantastic articles about such developments. And I think, in this space we're still very much at the beginning, but people are slowly but surely joining this dance or this bull market. but we're just far away from crazy valuations and the crazy market sentiment. So I think it's pretty much of the sweet spot for any investor at the moment.
And in talking about kind of forecasts and valuations, you have a section in the report where rather than putting one forecast on it, you give probabilities of various different price levels. And I think you do that to the end of the decade, so for 2030. And the highest probability level that you gave was about 19%, and that was for a level between about $4,000 and $5,000.
Yes. That's our let's say monetary gold model that we introduced last year already. So based on this model, which is fairly simple, and I worked in a bank for quite a while, and I know the more sophisticated and complex models are, the less they work, especially in times of crises. So we try to really keep it simple, and therefore M2 growth and also trust in the monetary system are the main drivers for this model, and the highest probability, as you said, is $4,800 by the end of this decade. Now that sounds probably like quite a lot, but it is a 10% compounded annual growth rate, and I think if you would have told people in the beginning of the 1970s that gold will go to 850, people would have said that's impossible. This will be the end of the world. And I'm seeing a pretty similar environment at the moment. I think we made a comparison between the 1960s and 70s and the last decade and this decade, and there are quite a lot of similarities from my point of view. So after a very, very long disinflationary period, nobody really knows how to navigate in an environment of inflation. And I think that many fund managers, financial advisors, and so on will be caught on the wrong foot in the Western world. While if you talk to asset managers from Turkey, from Brazil, from high inflation countries, for them it's just normal to think about inflation and to invest in inflation sensitive assets. And I'm always telling people that I did keynotes on gold all over the globe, and I think the best conversations and the best question asked were probably in Istanbul, in Turkey, because people know about gold, because they care about gold as they're navigating or investing in a high inflation environment. And I think those are skills that will be needed going forward. So therefore I think it's for investor, for a generalist investor, I think gold is really becoming, it has been some sort of a satellite investment, and something for as an active asset allocation decision, but now it will go more into the core. I think really over the next couple of years, many institutional players will say, well, we will substitute parts of our bond portfolio for gold, and this is already happening. We saw it with the pension fund in the Netherlands quite recently, for example. So I think this movement is really beginning now.
Two questions for you, Ronni. The first one is, at $5,000 an ounce for gold, in your prediction, what's that mean for the stock market, for the S&P and the Dow, say, for example? Where would you see them if we're looking at $5,000 an ounce gold?
Well, I would say that it's that the Dow Gold ratio will probably fall. So the purchasing power of gold measured in stocks will rise. It doesn't necessarily mean that the Dow Jones or the S&P must fall. I just think that gold will outperform. A bit like in the 1970s, for example, where Warren Buffett wrote a brilliant article about inflation, how inflation swindles the equity investor. It's a really good piece. So I think in an inflationary environment, if we go above this feel-good zone of inflation, which is at probably 3.5%, then equities really get affected negatively. So at some point, people will realize, or will question, does this company have pricing power? And therefore, I think that the narrative that stocks being real assets, that they're a perfect inflation hedge, that's just not true. And we crunched the numbers on that. You have to be more selective in a higher inflation environment in the equity market. But long story short, I think that gold will outperform the equity market.
And just to bring a bit of balance to it, obviously we have members of our community who are extremely bullish on gold. So you put about a 2.5% probability on a $12,000 plus level of gold by the end of the decade. But on the other end of the scale, if we're still sitting here in 6 months or a year's time and gold is still around $1,900, what, in your opinion, has to happen in order for that to happen?
Probably the easy answer is rising real rates, and I just don't see that. So this, but also I think it's great as a thought experiment to think about what could go wrong. That's actually something that every investor has to do at the very beginning of the decision making. And for me, for gold, the main thing is, well, we would have to see significantly higher opportunity costs in the form of higher real rates. And there's a great study by the World Gold Council saying that at plus 2.5% real rates, gold starts having a really hard time. I don't see that. We would probably have to see lower debt levels, central banks that don't try to fine tune every economic cycle, but also every equity cycle or asset price cycle. I just don't see it. I see really more aggressive policies since the beginning of the COVID crisis. I see that, as I've said before, MMT, UBI, helicopter money, all those things, financial repression, they are just basically taking over. So therefore, this makes me pretty confident regarding gold over the next couple of years. But honestly, I don't want to see gold at 12,000, because it would probably imply that a pint of beer would be, I don't know, $20 or even higher. And I don't think it is the job of gold to make you rich, but the job of gold is to protect your purchasing power and to protect your savings, like a good goalkeeper or a good defender. Now, as the Euro starts, I have to start again with football analogies. So that's really the job of gold, and I think it did that job pretty well over the last couple of centuries, and it did that job pretty well in 2020, in one of the most turbulent and interesting years for every investor. So therefore that's I think it's a pretty good setup for gold, a great macro environment, but also from a positioning and from a sentiment point of view, I don't see any extreme optimism yet.
So for those that are looking for $12,000 an ounce on gold, it's a case of being caught between be careful what you wish for and prepare for the worst, but hope for the best. Finally, Ronni, where can people download the In Gold We Trust report? And I would recommend that anybody, even with a passing interest in gold, downloads this report, because it's by far more than just gold. It gives you a wonderful lens to look at the current state of financial markets through. So I highly recommend that people download it. But where can they download it from?
Probably it's easiest at our webpage, ingoldwetrust.report. We've got the full version, which is 350 pages, and I promise that it will be worth the time. It will be a good investment working through the whole report, because it gives you an overview about all the things that are really important, not only inflation and central bank policy, the debt development, also how to safely store your gold. We're talking about gold confiscations, about mining stocks, the technical views. We've got fantastic interviews with Russell Napier, for example, or Fofoa, the famous blogger. We've got a great article by Robert Breedlove asking, what is money? There's a chapter by Lynn Alden about long-term debt cycles. So I think it's a really, really good and thought-provoking read. ingoldwetrust.report is the webpage. You can download the full version, but also the compact version, totally free of charge. And besides that, we've got many other publications. We're pretty active on Twitter. We publish the nuggets, so those are small slices of the report via our channels. And good thing is all our information is available totally for free.
In goldwetrust.report. I'm going to put a link to that report down in the show notes below this video. So click there. And as I say, I highly recommend that you download this report and go through it at your leisure. Ronni, once again, it's been great talking to you. Thanks for joining us on GoldCore TV today.
Thank you very much, Dave. All the best. And see you soon. Bye-bye.
Thanks for watching. And if you want to see more interviews with thought leaders and industry experts in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you enjoyed this video, check out these other videos that we've done with Jim Rogers and with David Brady.